Over the Road article, May 2009. Taxes, Clint Eastwood style. Meal expenses seems to be the most controversial portion of operators' income taxes. It represents a significant opportunity for fending off or escalating taxes. Classifying this cost expense is sometimes instrumental to survival or being gunned down by the taxman. As in Clint Eastwood's classic movie, there is the good, the bad, and the ugly. Most designated accountants have informed their self-employed clients that they must use actual meal receipts as expenses. On average, a driver retains only $20 to $30 per day in receipts. In the income tax form, the $30 is converted to a non-refundable tax credit of only $6.36 per day. Bad. However, a large number of non-designated bookkeepers still use the driver's logbook and its corresponding TL2 guidelines of $51 a day. At $51, the non-refundable tax credit works out to $10.80 per day. Better. But calculating the risk of losing everything in an audit? Ugly. Then there appears to be several ways accountants have dealt with the operators initiating the incorporation method. Some bookkeepers have claimed all the income and expenses through the corporation, meal receipts included, but then classified the shareholder operator as a subcontractor, having the corporation claiming no income and the operator claiming self-employed commissions as taxable income. This method is wrong on several levels and provides absolutely no value to the operator. Ugly on many levels. There is another method that many designated accountants have seemed to gravitate to: incorporation and the use of the TL2. For those operators who refuse to collect meal receipts, some accountants have correctly classified them as employees and issued T4s from their corporation, clearing out all income to the president, vice president, and driver. Then, using the logbooks and the TL2, completed the driver's income tax, claiming the $51 per day or $10.80 non-refundable tax credit. This system is the most conservative and provides the best alternative to the above options. Good. However, there is one final system that provides the most beneficial tax option the trucking industry has seen in several decades, though slightly more complicated. It is incorporation with an employer-employee agreement using per diem or subsistence allowance. The driver receives a monthly salary and a separate per diem check for meals in travel status. The accountant issues a T4 to the driver. It's filled out without the TL2 since reimbursement is already made. Depending on the reasonable per diem rate upon which the president and the driver suggested Treasury Board figures of $83.25 per day, April 1st, 2009, the reclassification of income to non-taxable benefit can represent a significant annual savings of $6,000 to $8,000 over the bat. Fantastic. As Clint Eastwood stated, you see, there are two kinds of people in this world, my friend: those with loaded guns and those who dig. Have a good trip.